All right, good morning, everybody. Let's see what the check a setting real quick and we'll be ready to go. All right, that should do it. It's Friday. I think it's Friday. It's Friday. So like we usually do, we want to take a look what happened around the world. A really good place to do that is at Finance Juice. We continue to pull a little farther away from the brink of destruction, which is always a good thing, right? The British pound had made it back to or near to where it all began. So it kind of like a reset. We have a large amount of speakers again today and a whole lot of data coming in today. Now, most of this data is not the preferred Fed data, right? They got their specialty that they really like. And this ain't it. And you can see from our current spot at 3 that they're still leaning towards a 75 basis point rate hike for the November 2 FOMC meeting. This was starting to get unwound, and now they're like putting it back in. This is the last day of the quarter. It's also the last trading day of the month. Captain Obvious, right? But it means a lot that it's a quarterly candle close. So you'll probably want to update your higher time frame charts. We've seen numerous times this week at the additional auctions had no takers, no buyers. Now that doesn't imply that they weren't bought. There are banks that are obligated to buy them. They would just rather not have to obligate banks if somebody else is willing to buy the debt. These speakers are not likely to say anything new today that we haven't heard them already say through the week. Remember to always check to see if you can find it, where they're going to be speaking or what they're going to be speaking about. A lot of times it's a luncheon or some kind of conference on finance, and it's not necessarily directly related to what's going on right now in the current world and market events. Yesterday we had a really nice pullback in the dollar, while at the same time we had a solid pullback in the equity markets, or the stock futures. I guess we could just say it that way. And we had the bond, like the 30-year. I mean, it closed down, but nowhere near as much as, say, the S&P and the Nasdaq. We absolutely are at a critical level. This is a spot that you could look at as they need to defend this or else kind of thing, right? Like if they don't defend this spot, then the or else is we're very likely going to come back down to the pre-COVID high. That'd be 3,400. We're definitely not done with these lows, and we're kind of due for a little bit of a bounce. I was talking about that island reversal the other day. On the ES, it's not there, but in the SPX, it is. So the way that an island reversal, you get the gap down. Then you get an island of candles, and then it gaps back up and runs, right? And then there's that gap that just exists there. And of course, the whole thing is discounted if we just continue to sink down. So one other thing that would discount this is if there's no longer a gap. So if we come up and tag that and then pull away from it again, well, it closed the gap, then it's no longer an island reversal setup. So we're looking at the advancing versus the declining issues in the Nasdaq yesterday. And I'm going to kind of zoom in here a little rough for a moment, but what you'll notice is it's a flat line. We were completely and totally pegged out. There was nothing more. There was no lower that we could go. Think about when you stomp your foot on the gas pedal in your car. Well, once the pedal is down as far as it can go, that's it. No matter how much more you push on it, it's not going to give you any more room with your foot. But the car will continue to accelerate even though you can't put your foot down anymore. Right? Kind of makes sense. Well, it's the same thing with the market. This is advancing versus declining issues. My little label up here in the corner doesn't use advance minus decline. It's only looking at advance, and it's asking the questions like, out of 100 names, how many of those names are actually advancing? 3. Okay. So if we took advance, which is 3, and minus decline, what would the number be? And that's what this thing is calculating. So advance minus decline. We call that pegging out, right? It's pegged out. It's giving you all it's got. The S&P started out pegged out, and then it kind of picked up off of those lows because we were starting to get some names that weren't riding with the rest of the group. Now, if you notice, finance yesterday, although it had the hard gap down, it pretty much kept its kept it all together, right? It kept its stuff together. Whereas, technology fell out a bit. The reversals or the stalls that came yesterday, if we're looking at the ES or the Nasdaq, they kept tying in when the finance here came up to where we opened and failed to continue that breakout. Now, this is one I haven't shown you guys before. I recently built this. Its design is based off of an indicator that Thinkorswim doesn't have. And when I say indicator, I mean a market breadth indicator. Like advanced decline is a market breadth indicator, right? Tick, trend, UVol, DVol, those are all quote indicators. They're just really old, like market breadth indicators, have been around forever, right? There's a market breadth indicator that Thinkorswim doesn't have, and that's not really a surprise. There's a number of old school market breadth indicators that Thinkorswim doesn't have. So without looking at the top, right, the name that's in there, I could put any name in there, it wouldn't matter. These lines are not based on what chart I'm on, right? They're only based on what time frame I'm on. So on the right hand side, this is the weekly for the Nasdaq and the New York Stock Exchange. And on the left side, it's a daily chart for the New York Stock Exchange and the Nasdaq. All right, so the label tells you what index or exchange we're looking at, and the time frame tells you what time frame we're looking at. I added a Bollinger and a couple of moving averages. What I wanted to point out is that we're at this critical level in the New York Stock Exchange. It's this previous low from back in May. We had the May-June low. Well, we broke the June low. We still have that May low, and it's a real critical spot. Now in the Nasdaq, we broke it plus some. I mean, we're sticking outside the bottom of the Bollinger. Hasn't even caught back up yet. On the daily, we do have this little double bottom from that June-July must-save area. I mean, we're right there. This has to turn around, or things are going to just get absolutely nasty out there. Now, that's the Nasdaq holding at that spot, whereas the NYSE has already broke through that spot. Right, so a little bit of difference between those two, right? Now, this is for cumulative volume. If you were to go and search for cumulative volume, you would find, I think Bar Charts has it, or I mean, there's a couple of places out there, right? This is cumulative new high, new low. Same scenario, same situation. NYSE, Nasdaq, day, week. Now, normally you would have another chart involved with this that would be your correlated chart, right? We'd be looking at like the Nasdaq, the S&P, the NYSE, and asking, okay, well, when this rolled over, what did the S&P do? Or when this hit that double bottom, what did the S&P do? Right? The reason I didn't add that is just if I had that on here before explaining what these would do, everything would just be more compressed. It would be more cluttered. It would be more confusing. I look at this a lot. So to me, it's not new. It's not confusing. But I get it the first time you look at it, it probably looks like a lot. So cumulative volume, cumulative 4 weeks, new high, new low. And then the last one, advanced decline, cumulative advanced decline. Again, coming into a critical, absolutely invaluable spot. It has to hold this or things are going to get nasty out there. So far, they're defending it. And we can wick through these zones and come back out of them, right? It's not like, oh, well, we wicked through the bottom and now it's Armageddon. No, it's not like that. All right, we're sitting at around 2.25 this morning on the volume, and that's not too bad considering we've seen 300 this week. So we're not in the extreme to the high side, and we're certainly not sitting really, really low. The volume is a little heavy, but nothing even remotely extreme. And that's all we needed to see out of it. We turn it off, get it out of the way. All right, we crossed through the daily pivot point a few times. So that really doesn't have any validity anymore. We've crossed through the Globex open a few times. We're right back to that spot, literally as I'm talking. So that one doesn't have any weight or validity to it anymore. If things are to get nasty today, we would first need to finish breaking through the Globex open. We'd need to get through our low 36.40, then the RTH low of yesterday 36.21, ADR half at the cog line 36.11, and then a full ADR at 35.63. There is a JP Morgan put in the SPX. It's a massive put spread, and the target on that is 35.86. Now I know we're not in the SPX, but it's a similar product in its numerations, right? So it's just a ballpark. We do have a market maker move on the books today. So when we measure out the expected moves, we want to add that number to it. It's a 1% expected move on top of the expected move that we already have. So if we look at this range and we say, well, we could go 2.5% because that's been the daily range, the daily average range. Take that 2.5 and add 1% to it, and that's what they think we could move today. So that's a 3.5% move from the Globex open. So you can just take the drawing tool, run it down there, 3.5%, 35.28. Now we can go to 35.28 and it wouldn't even be considered extreme. Looks like 35.30, right? This, a move all the way down to that number would not be extreme. That would just be like a regular day in the neighborhood. If we wanted to calculate extreme, we'd have to calculate even farther than that before things would start to get extreme. Now, rate of change becomes really important in a discussion like this. Moving down to 35.30 or whatever that number is wouldn't be extreme if we had started moving in that direction last night and we did it over a 12 to 18 hour period of time. But half the day is already done. So looking at it from this point, saying, could we move down there between 7 and 4? That rate of change would be kind of extreme, right? Where we would close at the end of the day down at that 35.33, that wouldn't be extreme, just how fast we got there. So if we are to make a move like that today, it won't be subtle. It's not going to sneak past you somehow. If we are going to start moving in that direction or close down there today, it's going to look something like that. You won't miss it, right? It won't sneak past you. It won't be subtle. So kind of keep that in mind. Oh, guys, I got to swap you off onto the other screen. How about that? Yay. I'll end up loading the Zoom onto YouTube for you guys. since the front half of that was not on there. So today, Chicago PMI, consumer sentiment, and the rig count. Now, the thing about the rig count, it's not likely to be very impactful unless there's a huge, significant number of rigs change. And even then, I wouldn't expect it to be too significant, right? So by 10 a.m., after we get through the consumer sentiment, all we got left is like Fed speakers. So, as long as those Fed speakers are just kind of saying the same things that they've been saying and nothing new is coming out and they're not going to try to buck the system, should be a reasonably decent afternoon that whatever we have, if we stick with, which would be nice, right? Getting a day where we actually pick a direction and run it all day. Now we've pulled back from the brink a couple times and it's all around that 36.25 area. So just really proceed with caution when we get down into that zone. And again, it's not like oh, we wicked through that, we're done. It's more of if we get through there and then it starts to accelerate past that. Yesterday we had a absolutely massive Apple put sweep come through. And the market did not like that and kind of legged us down into a new area. And I thought that was going to be the end of it right there. But yet again, we pulled back out of it. Let's see if I have a copy of that. Of course I do. So somebody bought 20,000 puts at $2 a piece, set to expire October 28th. And it's the 125 puts. And they bought those when Apple was sitting at 141.91, basically when Apple was sitting at 142. And they spent 4.3 or $4 million. Now I say spent, but this alone, we'd want to go in and say, okay, well, was that a buy or was that a sell? Now, technically, the answer would be yes, because you got to have a seller and you got to have a buyer or there is no transaction, right? So on the one hand, it's always a buyer, it's always a seller. But it becomes a deeper question of, well, who initiated the trade? Was it a buyer looking for a seller or was it a seller looking for some buyers? Right? Was this a person opening a position by selling to open, or was this a position opened by buying to open? And all the difference in the world, right? Because when you sell a put, you believe the market's going to stay above that put strike. And if you buy a put, well, you want the market to go below that put strike. It's the 125. So this was an out of the money put, right? Now, if you don't like stops and you want to protect yourself, when you buy a put, you can do that, right? So say you owned Apple at $100 and Apple goes to 150. And then you get into a situation where the market's kind of melting and you want to protect your trade, but you don't want to use a stop. Well, you could buy a put at 125. As long as we stay above 125, you lose the money from your put, but you don't lose your stock, you don't lose your position, and everything is fine. Call that insurance. Yet if Apple was to fall down below your put that you bought and falls to $97, you're still able to sell your shares at the strike you bought, the 125. So no matter how Apple falls, you would still be able to sell it at the strike you paid or picked. So the alert by itself, unless it says what the bid or the ask, or if it was on the ask or on the bid, unless there's something else in there, then you don't know. Like this alone doesn't say enough, but it's designed to get your attention so you can go in and do the rest of the work yourself, right? Now these places, this is Whale Stream. There's a lot of places out that do this. Some will give you alerts for like the junkiest stuff, and then you're just getting these nonstop constant alerts that are just like, who cares? This is trash. This is just noise. So I like the Whale Stream one because it's concise. And when you get an alert, it belongs to something that you really want to go look at, right? It's not just like a bunch of noise. If you don't have any of those alerts, check your Discord. I think you can use something like Options Fam or the new Open BB, which is the new Open Bloomberg. Things like that. All right, so we've talked about a downside move in the S&P. Talk about an upside move for a moment. The market maker move would still apply for that direction too. So from the Globex close through the daily pivot point, through our own Globex high. Well, at this point, we're holding above the Globex. So we would cross back through that worthless daily pivot point, and it's worthless because we've already crossed it a few times. Challenging and breaking out above 36.94 would be the key, the start of all of it. ADR half at 37.02. The Globex high last night, it stopped going up when it hit the cash open from yesterday. Imagine that, right? Open, high, low, close. Those pivots, as generic and simple as that seems, damn, that works really good. I mean, it just really works great. And you didn't have to buy some crazy expensive indicator to figure it out, right? Open, high, low, close. So if we can get through that pivot point, it's basically also the RTH high of yesterday. It's really close to being the RTH high of yesterday. So we get through the ADR half. Then we've got the real high of yesterday, 37.35, and then the full ADR at 37.49. And keep in mind, we've got that additional market maker move, right? So instead of 2.5, we could move 3.5. And that means also to the upside. $37.85. To get to that spot, we would have to get through the weekly pivot point. And it is also the high of the week. We would have to get through that as well, right? So a couple of pivot points are in our way if we were going to move the entire market maker move and the ADR. And again, that would not be considered an extreme move other than how fast we would have to move to get there because half the day is already done. should we actually break this low and start moving beyond that June low? We do have some pivot points. I showed these the other day. I wanted to show it again because somebody asked, you know, what are all the pivots? I'm gonna just stop there so you guys can, you know, just take a screenshot and you'll have it. They're not based on any sort of math formula or indicator or anything like that. If you read what it says, it's a weekly gap or a daily gap or a monthly gap. And we had a monthly gap. We took it out yesterday. I left the line on there because technically the month isn't done yet. So I'm going to leave it on a little bit longer, but I cut it down to where it's really just right there in that little zone. 36.21.63 was a monthly gap that got filled yesterday. A little note on these gaps. You can mark both sides, where we closed and then where we opened. But think about it, if you only want one line, think about it from the direction of, well, how are we going to fill that gap? By moving up into that area or by moving down into that area? So all of the lines that are overhead from this low that we're in, all these lines are set to where we had closed the day of the gap, right? So, or the day before the gap happened. So we close, and you know, I'm using the open on the green candle here, but technically, you know, if we wanted to get real crazy with it, you'd mark it from where we closed and then down here where we opened. So think about it from the perspective of, if we were a market rising back up, marking this spot wouldn't really make much sense. It would be marking the other one because that's the gap that needs filled. On the other hand, for the lines that are below us, the other side needs to be marked, right? Not the top, but the bottom, because we'd be moving down into these lines. We fill the gap by moving down to them. So it wouldn't make any sense to mark the one where we opened the following day. It makes more sense, again, to mark where we closed. Except for like down here. There's always a little oddity to everything, right? So it's still make or break. This is the point to everything. It's still make or break. What we're wanting to see here is that this monthly candle closes above this previous candle. The low is already in. There's nothing we can do about that, right? So we have a new low, but we don't have a lower close yet. And in OCR, that lower close means a lot, right? Now, counting from this close to that close, I mean, we're getting a lower close there anyways. We're more talking about, say, like the pivot or the turn when you're looking at like Linreg. So really watch for that defense today. It should be a strong sweeping flow if we're going to see that upside move, right? And it's going to be tied directly in with a correlated market state, a highly correlated market state like we had yesterday. This thing was pegged out. It couldn't go any more correlated. You had every single name in the Nasdaq all moving in one direction. Nothing was going in the other direction until around lunch, and then it came up off of the lows a little bit. If we were to get crazy bullish today, we would need that kind of correlated market state, a high correlated market state. All right, so we're looking at the ES 10-day, 30-minute volume profile and TPO. We are still inside the box. We still have a significant level of volume between 37.10 and 36.80-ish. If we're going to make any kind of significant rally to the upside, we're going to have to get through all of that trash. But if we can get through, call it the cog line at 37.11, if we can get through that, we start getting into this shallow zone, and it stays shallow until we come up into that 37.80 area. So we have to get through this trash, and the longer we stay here, the more we build up. Every 30 minutes, we're going to get a new candle on the right, and we're going to lose a candle off of the left. And this point of control is going to suddenly just shift, and it's going to be down here. Mainly because here in the middle, we didn't stay there long enough to build volume. So as we start taking out more of these candles, this volume profile is just going to poof, have a point of control down here. Not today, right? All right, nothing to carry forward on the point of control from yesterday. We've already gone through it multiple times. The value area high and low is really close to the high and low of yesterday. So that doesn't have any value for us. There's nothing to do with any of these, right? You're not going to get any value out of these volume profiles today. We've got next week's expected move on the table already, but it's not locked in stone. It's going to continue to move through the day, and then after the close today, it will lock into place. But at the moment, you can see that they're pricing in more volatility for next week. Right? And it's just a real simple thing to draw a box on the week that we had, and then grab that box and try to put it on the next week and see how much bigger it is. Just a simple little exercise. This is, at the moment, the first week in a while where we're actually going to close the week inside the expected move. So far, I mean, the day's not done yet. We certainly could break outside of it still, but we failed that week. And we failed that week. And although it wasn't by much, we also failed that week. And that one. And that one. So we haven't closed inside the box since 8/19. 1, 2, 3, 4, 5 weeks in a row, we've failed the expected move and moved farther than that. That's how off they are. the reason it matters is if you're trying to run like automatic iron condors and things like that, this is telling you, hey, the market makers are getting it way wrong right now. Generally, they'll be spot on perfect and they'll hit it for weeks and weeks and weeks at a time. And an occasional miss is no big deal. It's when the misses start to pile up again and again and again, week after week after week, that you start getting the kind of a red light warning. So after all that volatility and with the crisis that we had this week, literally like economic ruin was one domino tip away. We're in the box. It's just absolutely astounding. But there is a significant level of market maker move on the table today. So they're seeing something or it wouldn't be there. And next week is pricing in a higher one. So there's a lot to be gained from looking at these expected move levels. Now, since we haven't gone anywhere, it's given the 10-week time to catch up, and it really hasn't, right? If you look at what we did for the week, but remember the weekly will more than likely only update once a week, right? Because you got to get a weekly candle close before that 10-week moving average prints a new price point. So instead, flip over and look at the day. How far away from the 10-period daily moving average are we? And you can see that over the last week, even though we haven't gone anywhere, we've gotten a lot closer to the 10-week, right? Because it's like I talk about frequently. Once we move that average distance, price is either going to pause there and let the 10 catch up, or price is going to reverse there and move back towards the 10, or both. Now that end of quarter, end of month, we talk about the JP Morgan caller a lot, but it's not the only one. And I'm still going back and reading through. It doesn't make sense that they used this expiration, right? Think about it. That caller is huge. I mean, it's massive. Billions of dollars. Why would they use an expiration that wasn't on the monthly? I still don't get it. But it is the end of the quarter, and that might have been, the quarterly expiration might have been more of a pull to them than using the monthly expiration, right? It's the only thing I can think of. And the thing is, we know about the JP Morgan one. How many more of them do we not know about? Now, last week, 40% of all of the options that were set to expire were for last Friday's expiration. And they had a lifespan of 2 days, right? It was all over the place. Everybody was talking about it. Yeah, there's still a number of positions that besides the JP Morgan one that's going to need to be rolled today or closed, right? And I don't see them closing a lot of this. So keep that in mind. I can't disagree with you, Nicole. I can't disagree with you at all. For those who can't see the chat that I'm referring to, the statement was, do bankers really know what they're doing? And, you know, if you look at the 07, 08, I mean, they knew what they were doing and they did it anyways because the risk was so low that just like in your own work environment, when you find somebody doing something stupid and you say, hey, what are you doing, man? That's stupid. And they say, what? This is how we've always done it. What's wrong with it? It's a really bad idea. What you're doing is dangerous. Nah, it's okay. It's what we've always done. I'm sure everybody's heard that phrase at some point, right? Oh, we're just doing what we've always done. This is what we do. It's fine. Nothing bad has ever happened before. It'll be okay, right? Until it isn't, right? So do they know what they're doing? Oh yeah. Yeah, they know what they're doing. They're assuming that risk is not going to get out of control and that really bad things won't happen because, well, they haven't happened so far. Ask how it's working over in Europe right now. Yeah, the fake Russia referendum is happening today. I didn't mention it today, but one thing that you'd want to do to kind of get ready for your day is to sign up for the 5 things you need to know from Bloomberg. It's free. So I'm not signed in right now, although I have an account here. But without signing it at all, you can come over to Bloomberg and look for 5 things you need to know, and you can subscribe to it. They'll send it to you in an email, and it'll just kind of give you a heads up on the day, right? And it's a really concise, short little excerpt. And a lot of times, maybe it's not going to tell you something that you didn't already know, and that's okay because there's a little diamond in the rough sometimes where they give you a gem that you didn't expect and it's free. So there's that. And then there is morning, or is it Cup of Joe? I think it's Cup of Joe. Nope, I'd have to look. Theirs is a little longer of a publication, and I've only recently started reading it. And it has ads in the email, and I hate that. So I don't look at it very much, but there is another one also out there. And again, it'll just be an email comes to you. And believe it or not, Robinhood for a little while was doing something like that. And TD Ameritrade has a really great morning briefing kind of a platform that works out really nice. Morning Brew, that's what it's called. All right, so there is another publication called Morning Brew that you can go to by just Google it, you'll find it. I don't like their email as much as just coming over to the site, but they have a really great amount of information for the morning too. And it's free, right? You don't have to pay for that one either. So when it comes to getting ready for the day, there's a lot of really great resources out there. Yep, Seeking Alpha, but with the Seeking Alpha one, I like their podcast, right? Rather than any kind of emails. When I had a subscription to them, I liked their emails. I didn't like the free stuff that I was getting from them. And then I did build a Twitter, because I hate Twitter. I don't want to go to Twitter, but there's a lot of really great information that's out there. I built this Discord to follow a couple of different kind of segments out there. It's got TD Ameritrade on it. It's got Investors Business Daily, but it also just has a lot of fund managers. And you would be surprised at how much these fund managers share their insights, right? Especially with that $25,000 Bloomberg machine that they use. Now, again, these are just people, right? A fund manager just means that he's managing a lot of money. It doesn't mean that he knows what he's doing. So, if it's not like you want to read these and say, oh, well, Joe from JP Morgan is buying Apple today, so I'm going to go buy Apple today. That would be a bad idea. Here's that chart overlay. In white, it's where we are now. In yellow, it's where we were in 2008. And we've been able to track what the anticipated next move is nearly on a week-to-week basis. We're expecting a little bump to the upside and then significantly break our previous pivot point for a new leg down. That's what I'm looking for. So anything that looks like this is from that Bloomberg machine. Just so you know. So if you see that and it's an original post from someone, check their bio and see if they're a fund manager. So the point of it all is, guys, to be very careful. Today is the day. If it's going to happen, it's going to be today. Otherwise, if this holds, then we're very likely going to get a rebound rally, at least a small one, right? I was looking more into dead cat bounce, right? It's just, if you don't know what I'm talking about, when a market is trending, moving in a particular direction, and then it pulls back before continuing on in that direction. Well, we can say, oh, it's a flag. It's, it's this, it's that. Well, that pullback is the dead cat bounce. But if it pulls back too far, then it's not just a pullback, right? It's actually a change in market sentiment. So the pullback needs to be enough. But if it's too little, then it doesn't count either, right? So if it only pulls back a little bit and then it continues to go, well, that's not a dead cat bounce either, right? So if it pulls back too far, it's not. And if it doesn't pull back enough, it's not. An argument could be made that that little pullback right there wouldn't have been a dead cat bounce, right? It didn't pull back enough. Let's get on a daily. This is year to date for 2022. I guess it makes it a little better if we just add a full year. All right, so we had the move to the downside and then a pullback. Now that pullback was like half of the move, right? So we could call that a dead cat bounce because it took at least half of the move. But later on, when we continued to the downside and then we had a pullback right here, an argument could be made that that wasn't a dead cat bounce at that point. It was a 1 or 2 day candle. It was just a minor pullback of this much in a market that had already fallen that much, right? But that pullback actually almost went too far. That pullback, however, wasn't just a pullback. It was fueled by that FOMC from March 16, and Apple went nuts, right? And it was just that like nonstop runaway freight train. So it kind of went parabolic. not a dead cat bounce in my humble opinion, because we went too far. Right? It would have broke the metrics for what we would be looking for. Quantitatively, this one came back too far. The fact that it set a higher high than that high first, just I didn't like it. If we were going to maintain all of our metrics, then we shouldn't have had that, and we did. But for the dead cat bounce part of it all, I really think that was too far again. But if you go back and you start reading more about a dead cat bounce, they'll put a number to it, and it's usually like 8 to 15%. So, you know, you can use your thinkorswim drawing tool, kind of just come in and measure. That was a 9% move. 8 to 15, that's 9. So that fits. That's a dead cat bounce. Or say, you know, from here to here, 11% move. That would be a dead cat bounce, right? See how the trick works, right? The calculation. So if we're looking for a dead cat bounce now, you could reach out a good 8%, and you kind of use that for a guidepost. Somebody's got a market maker move question. The question is, with not much news coming out today, why would there be a market maker move? The market maker move is not directly connected to news. It's directly connected to volatility. No, Nike had earnings, right? That earnings takes precedent over technical analysis, right? You don't apply technical analysis to a market that is not moving in a normalized market state. So the market maker move uses front and back volatility. When the front volatility is higher than the back volatility, that causes the market maker move to begin to get calculated. And that is all that it's based on. So generally, we'll get front vol when there's an event like earnings or news or something like that. That's generally where it happens. But for an example, the SPX doesn't have an earnings, so we know it's not that. Things like the futures, they don't have earnings, so we know it's not that, right? Here we've got a market maker move, and we've got the front contracts higher than the back contracts. The reason I know so much about the market maker move is because I know who made it, and I know where all the resources are to learn how to literally have it laid out for you to understand every part of it. I've heard some very famous, very popular, well-known people talk about the market maker move and completely screw it all up, almost as if they're just pulling stuff out of their shoes and having had no research at all. I'm not going to name them because that's just not nice. So what you're looking for is the ticker tape from TD Ameritrade. And if you go there and you type market maker move, you're going to find all of these articles. Some of them explain in detail what it is, especially this one, Ask the Coach, Market Maker Magic Move. Some of them just show it being used in the article. But by the time you're done with these articles, you will thoroughly and totally understand not only what the market maker move is, but why it was designed in the first place. And it's a think or swim thing, right? they're not the ones that invented the concept, but they're the ones that really popularized the MMM like brand, I guess we'd want to call it. And a lot of brokers just don't offer it. So once you know what it is, you can go get it for yourself, right? Because it's just the difference between that front vol and the next following series volatility. But if you ever have something on Thinkorswim that you want to know more about, how it does a math formula, how it does ratio, what sizzle is, I mean, whatever, come here first. You would be surprised at the resources that you'll find in this, and it's free. I'm not signed in. You don't have to even have a subscription to or an account at TD Ameritrade to use this. One last thing before we go, we want to check volatility. This is supposed to start in the lower left and run across to the upper right, and that would be contango. It would be normal. Instead, we're starting in the upper left and we're going down to the lower right. That is backwardation. So we are still inverted. The front contracts are more expensive than the back contracts. Keep your eye on this today. If we are going to start rallying out, and remember, we're not looking for just like a grind out. We're looking for one of those SpaceX rocket ship style, take it to the moon, baby, kind of rip out of the hole, right? And if we get something like that today, watch the VIX. We want to see the VIX and not the dollar. Not, yesterday showed us that right now, using the dollar like we've been using it, not a good idea. Because yesterday the dollar was falling right along with our market, right? So that absolutely was not a useful metric. Normally, if we had the dollar selling off like that in the last, say, 2 months, the S&P and the Nasdaq would have been taking off like crazy to the upside. And that's not what we had. So today, don't use that dollar that way. Keep your eye on the VIX instead. If that VIX breaks below 29.5, breaks outside of at least yesterday's price action, so call it 30.5, then we could really start to see a rally in the S&P and the Nasdaq this afternoon. Keep your eye on the correlated market state, which you can use if you go to the market watch, visualize, get rid of the heat map, put it on index, choose your index. Nasdaq 100, what you're looking for is how many are advancing versus how many are declining. You can use the advance versus decline, but that doesn't have the money in it. It just has how many names are moving. I like to look at the money flow too. And these are detachable, so you can break it off and then you can load up more than one. And they compress really nice. You can keep them kind of all wrapped up, you know, to where they're not taking up much chart space. And then you can stack them, S&P, NASDAQ, NYSE. You can put your own watch list in there. I like to put the FANGs in there, the monsters of tech, and look at them as a group, what they're doing. And yeah, approach it from that point of view. All right, the 10-year is down a little bit this morning. VIX is down. Bitcoin, semiconductors, energy, retail, and then it gets into zeros and flats. So we move to the positive side. Nasdaq volatility is up 6%. Yeah. It's a whole lot in the middle that's not showing much of anything. So Microsoft up higher than it closed. We're starting to see a little bit of like a red to green. Be a red to green with a TRB, right? So TRB is a trend line breakover. We want to see it rally up at least as high as the previous day's open. At least that much. That way, when we do come into our open today, it fades down and finds support on that previous open, and then a rally up. A rally up first needs to get through yesterday's high, then start targeting, say, the close of the previous day, and then completely out of this clustered mess and hit the high from 928. That's not a bad run. Keep your eye, I don't have my labels on, but keep your eye on how far the market maker move is on this thing, and then what its average ADR is to get outside of that green candle from the open of yesterday would be 1.4, and Microsoft can easily move 1.4. Now, Apple and Tesla were the last two holdouts, and Apple didn't hold out no more, right? It's on the run. The weekly gap is still the magnet on that, so 132. Even if we do move up today, I really have no expectations that it's not going to continue to go down. The dam is broke. It's a little bit like breaking the plate, right? You can try to glue it back together again, but you're not going to get it whole again. The holdouts here, and the phrase that I really like is, if they're selling Apple, you know they're not going to go buy something else, right? Or if they're not willing to own Apple, they're not willing to own anything else, because Apple's the darling of Wall Street. So they start dumping this thing. That's the start of the capitulation that we've all been looking for. We need this thing to break, right? So even if it does rally today, I mean, I don't mind day trading anything. I'll day trade anything if it has the liquidity. So if you want to take it to the upside because it happens to rally in the intraday, okay. But in the swing setting, I would still be short on this. And looking at it this morning, it's not rallying anyways. It's down lower than where it closed, right? So it's not a red to green. It's not a rally setup. I'd still be short Apple. For Amazon, we've got 114.75. So it's basically right where it is. It's flat. Hasn't really done anything this morning. It's now it's cheap enough now. This trade might not work, but it doesn't hurt to mention it. You can go price it for yourself. If this stays flat like it is, or it wants to start moving around, but it doesn't get like crazy bullish, put a 0-day on, because it is Friday. You can 0-day a lot of things. Put a 0-day on using something like the 118, 120 call credit spread. And as long as it stays below that big green day, you got it. When Amazon was a much bigger product and it would have those big green candles and then would get a big dump day like that the following day, those were good, especially on a Friday, to set like a benchmark 50%. Now, I mentioned Tesla, so we may as well do it. Take a look at it. Critical level here. It's like the must hold. Apple broke the must hold, right? So Apple's done. It's already started the descent. The domino has been tipped over. Tesla's domino is still standing. And as long as that 265 holds, then it's just going to continue to drag on and drag on and drag on. We need that to break. Eventually it is going to break. I don't know if it's going to break today, but it's definitely what you want to watch for. 268.05 is where we're at right now. So this is not showing a red to green, and it's not rallying up. If we do get a little bit of a rally today, keep your eye on that rally rejection at 50%. That would be a beautiful pullback entry for a nice short continuation lower. So if we did start to rally here even a little bit, I would be watching that 275 as like the line in the sand to jump in to go short. I don't know if we're going to get a pullback like that to let us in, but I mean, if it started to pull back, that's what I would be looking for. It's late, way late. You guys be careful, be safe. I will get the Zoom video uploaded to replace the YouTube video since the first 15 didn't record right. Have a good weekend, everybody. I will see you all next week.